Morning everyone, today we'll talk about EZDK, their market value compared to the value that we have established for them, and why there is a difference between the two values and why this gap has occurred. But before we discuss the two values, we need to talk about the FCF versus the assets and equity. To value a company, some may look at the assets and the equity that the owners have put in the company, but this is incorrect. For financial managers, the only aspect they take into consideration is the FCF and the present value. In our case, as الدخيلة, other factors affect the decision other than the FCF. This is due to the fact that Ez has been losing a lot of money during the past 2 years, although they have a huge amount of assets that cover them. So what is FCF? FCF is how much cash is generated by a business after taking into consideration capital expenditures. Buildings and equipment are examples of capital expenditures. Now we can move on to the EZ Steel financial status. EZ Steel has been incurring net losses for the past 2 years. The last report for quarter 1 2015 showed a net loss of 49.7 million Egyptian pounds. On a standalone basis, EZ Steel has reported a net loss of 116 million. Yet the analysis showed that EZ is expected to do better for the next years to come. This is due to the fact of the decrease in oil prices, which will make the input cheaper. Also, the dive that the Egyptian pound took compared to the dollar. Now we talk about the financial summary. EZ Steel is currently valued at 8.4 Egyptian pound per share in the market. We value it as at 6.09 Egyptian pounds per share. This is 27.4% lower than the market value. So how did this gap occur? Although EZ is making and increasing losses for the second year in a row, and the market still trusts EZ. EZ has a total assets of 25 billion Egyptian pounds. The company has a total equity and liability of about 25 Egyptian billion pounds. This means that EZDK's assets still cover all the liabilities, and therefore the people trust EZ, since EZ has been making profits before the revolution, which affected the entire economy of Egypt. In conclusion, EZDK is still expected to make losses, therefore we assume a market value downgrade would occur, yet we do not expect that the entire gap would disappear, and we expect that the gap would remain, but in a smaller amount. Yet, we expect in a 2 years time, EZ would start making profit and their market value would increase again, and so would our value for them. We don't expect the downgrade to be severe because the market still trusts EZDK and they know that their assets are strong, and this trust is portrayed in the gap between our value and the market value. Although our value is based on mathematical equations only, yet the market value takes into consideration the trust of the people and how much the people are willing to put money in this company, even though if it's making losses.